Yesterday, I did a video on Michael Burry, his latest portfolio updates. This video continues the series talking about what are some of the super investors up to. This includes Warren Buffett, Stanley Druckenmiller, Prem Watsa, who runs Fairfax. We'll talk more about that in just a bit. When we look at Warren Buffett, what did he do during the fourth quarter? You could see his largest ad really is in the oil play, looking at companies like Chevron. And you can also see that he also started trimming some of his sizable holdings, like Apple. He trimmed a little bit. Now, you could argue his stake in Apple actually went up a little bit because of the net impact of buybacks, where his ownership of the company went up. But overall, from a dollars perspective, he reduced the position, by selling 10 million shares, what looks like. And, from a portfolio impact, around 0.5% of the portfolio. Also trimmed out a bunch of smaller positions that truthfully, didn't really add significantly to the portfolio. Were kind of a rounding error, probably a distraction for, from his perspective and from Todd and Ted, the co-managers of the different portfolios at Berkshire. So it is interesting to see that, for the most part, it looks like he's a seller. And this continues from the theme of the first 9 months for Berkshire, where, they were a net seller to the tune of looks like around $20 billion in terms of stock. So continuing that sale process. And so this does make me wonder, if it is prudent to raise the cash level. I've actually called this out now a few times, especially when I've seen some banana price action with stocks like ARM. I did a video on that recently. And so it does make me wonder if I should raise that cash. I currently keep my cash at Interactive Brokers. See the link below. It's a little interesting to see Warren Buffett, one of the greats, say, hey, I'm continuing to sell off my stock holdings. Looking at Stanley Druckenmiller, one of the very few investors who delivered 30% for 30 years. He was one of the first investors to really lean into NVIDIA with the AI revolution. He's done tremendously well. And in the most recent quarter, what did he do? He bought calls to lean in further. Now, he did trim some of his underlying stock, but this turbocharges that NVIDIA exposure. So I think if you do get some sort of blow off top or some sort of parabolic move, he would benefit from it. But it's also interesting to see that he's buying some materials companies like Tech Cominco, or I believe now it goes as Tech, which is one of the largest copper producers. And so this is Stanley Druckenmiller. And not only did he buy Tech, but he also bought, that's TECK, but he also bought 3 other materials companies that all are tied to producing gold. And this is interesting to see. So you see Warren Buffett's buying oil, Stanley Druckenmiller's buying gold. And, I previously called out Fairfax as one of my top positions. I've done 2 videos on it if you're interested in learning about my response to a short report on the situation and why I like Fairfax. And, look, Prem Watsa, over his multi-decade career at Fairfax, has delivered something like an 18% annualized return for shareholders, like trouncing the market over a multi-decade perspective. And so I'm curious to see, where's Prem finding value? And he too, he also owns a sizable position in an oil producer, but he's also buying gold. He's buying gold stocks, which is, that's the main contribution. So now I've seen 3 investors, adding to material space. Oh, now it's 4 investors. Look at Mohnish Pabrai. He's not doing oil or gold. He's going what looks like all in terms of his U.S. stocks, which accounts for around $250 million. I think he also has a large international portfolio, which you're not going to see in Turkish stocks and Indian stocks. He's also a super investor, absolutely trounced the various different, U.S. indices over time. But he's effectively all in terms of the U.S. portfolio on coal stocks. I previously did a video on his bet on AMR, which it looks like it's worked out extremely well for him. But this is just interesting to see. What is going on here? Traditionally, these types of value investors, are looking for quality companies. You see Stanley Druckenmiller, he's not a value investor. He's more of a trader, but he's looking for where the opportunities are. He's always thinking, okay, where are we today? Don't invest based on where we are today, but think about where we could be in 6 months from now, or a year from now, or 2 years from now, and sort of start placing bets based on, where the puck could go, where we could end up, in that future. And so it's very weird to see these material sector bets. And so what's this all mean? First of all, in full disclosure, this is not financial advice. Also, quick plug, yesterday, an Unrivaled Investing subscriber posted in our exclusive Discord that I've recently paid. This is a direct quote. I've recently paid my second annual subscription, and I couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions. It's not hyperbole. I actually did the math. And so that's my goal with Unrivaled Investing, to hopefully, where people can not only find compelling ideas, real-time insights, but hopefully the subscription pays for itself many years, possibly even decades in advance. And so check that out at unrivaledinvesting.com. I also have affordable educational materials as well if you want to learn about, reading financial statements or valuing stocks. So why are these, traditional investors that know you should pay and reach for quality, pay up for quality, Warren Buffett, Prem, Watsa, Stanley Druckenmiller, Mohnish, Pabrai. Mohnish Pabrai's even recently done some speeches about you got to circle the wagons, about the most compelling ideas, the types of things that you could own for decades into the future. What's going on here? Because, these commodity type of companies, that's not what I would think is hey, this is the incredible thing to own. So I think there's a new narrative that's important for investors to consider. And I think it has to do with understanding actually the macro and how that can influence investors, which is that we have uncontrolled spending in the United States where our deficits continue to be at multi-decade highs. You can see that the last time the U.S. deficit spending was at this level, around 6-7%, you're talking about fighting World War II. And so it is just, and it's expected to remain high in the years ahead. This doesn't even factor in the potential, deficit spending that could happen with a recession. With a recession, deficit spending would jump even higher. So, we're in this situation where I think a lot of investors are thinking, yeah, you can print money, but you can't print oil, you can't print gold, you can't print coal. You can't print these basic commodities. And what should you consider investing in if there's this risk of steady erosion that's accelerating or debasement of the currency, in this case, the US dollar? And so a few key thoughts on this. I already mentioned that how Fairfax is one of my top holdings, and I think that does fit into sort of the thesis in terms of how do you handle potential debasement. And I think there's really three different ways to do it. One of which is what you're seeing from these super investors, whether or not it's oil, coal, gold, which is that you own commodities that can't be easily reproduced, without, and those have their own challenges because each of those commodities is going to be driven by the supply and demand aspect. So like Tecumseh, copper producer, okay, so what are going to be the needs of copper? And if you have a recession, how will that impact the business? So each of these commodities have their own challenges. And not only do you have those challenges, but you also have, to think, okay, what's the replacement cost? What's the reserve life that you have? Because this isn't like a software company where you could, it's super high margin and you can just keep producing this for hundreds of years into the future. Well, with a commodity, you're oftentimes looking at a reserve life of maybe a couple of decades at most. And so you're sort of saying, okay, well, if we're using down this reserve, we're mining this facility, producing these barrels of oil, well, shouldn't that result in a lower valuation multiple? Because otherwise you need to put that cash flow into some sort of growth projects where you're mining or prospecting for a replacement reserve to offset, what you're producing. So commodities do generally warrant lower valuations for these reasons, but it is interesting to see these super investors buying. And I do think it is directly tied to this out of control deficit spending. And Warren Buffett also looking at it and saying, hey, I'm not finding a lot of super bargains. I think Mohnish Pabrai with coal, I think he's saying, hey, I like, the pricing. I don't think you're seeing a lot of new coal mines opening up. And I think there's, with that, there's been a lot of foolishness in terms of, hey, we should be opening up. And this is another position Druckenmiller did. He also bought or owns Cameco, I believe, which is a uranium company. And going back to Pabrai, though, the point is there's been this foolish pushback against clean nuclear energy in the past few years. And so, okay, so then you're seeing a more reliance on coal, which is just absolutely bananas. And so, he's looking at things trading at very low free cash flow multiples, and that's why he bought it. And I called that out previously, AMR. I did a separate video. So what's another way that investors can benefit? So one is commodities, and that's, I personally don't like that approach, just given some of the challenges I mentioned. But a second, key aspect, and this is, another way to deal with debasement, is when you're looking for companies with pricing power. The ability to say, okay, well, there is inflation this year, but because we have a critical good or service and we have that pricing power, we're going to be raising that price. And, I already mentioned that Fairfax is one of my top holdings, and I did those prior two videos on it. But the beautiful part about an insurance model is that when a customer is signing up for insurance, it's generally not discretionary. It's because they need insurance. They're saying, hey, I have to, the board of directors is telling me I have to make sure, I cover these risks. How much would it cost for me to insure against XYZ risk? And you go to the insurance company and, generally, as the costs of those risks go higher, the insurance companies also say, okay, well, the cost to insure is going to go higher. Your premiums are going to go up each year. And that's been one of the things Fairfax has benefited from in the last year or so, which is a tighter, harder market, which is the ability to raise prices more easily on premiums. Now, generally, insurance is also sort of a commodity, so it has to be done well, done intelligently. You don't want to, underwrite risks that are imprudent, but that ability to provide a good or service that is going to be required regardless, that is another way to handle debasement. So not only pricing power where you have something special and you could say, hey, this is See's Candy, we're going to raise prices another 5 to 10% this year, too bad, that's just the way it is, but also just providing a critical good or service. So we've talked about commodities, pricing power, providing a good or service. And I think another key aspect is looking at multinational companies. Fairfax is also a multinational insurance company, so it has insurance from a lot of different countries. So such that if you do have U.S. debasement, you're ultimately talking about, a lot of U.S. dollars being printed, but will all these other countries print currencies of the same way? Now, some of them will, but if you have exposure to many different countries in terms of the revenue, then you're less likely to be significantly harmed from the debasement of one currency. So I think those are the different aspects to consider, is the multinationals, but you'd still need to pay a fair value. So multinational, businesses, Google's an example where, it has a lot of exposure. I think around half of their business is US and half is the rest of the world. And so, considering those different angles to balance out what I think is the risk that these super investors are considering. You have Warren Buffett buying oil. You have Prem Watsa with oil and gold. You have Stanley Druckenmiller doing copper and gold. You have Mohnish Pabrai doing coal. So I find this to be, it's not a huge percentage of the portfolio. I mean, in some cases it is. For Pabrai, it's like 100% of his US stocks are coal. But for Druckenmiller, you can see at the margin, he's starting to add these materials, these commodities positions. So I think it is worth reflecting on if this is possibly the future we're heading to, which is that could we head to a situation where there's just a lot more money printing in the future that makes these commodities bets much more attractive? I don't like them by nature just because they're lower quality businesses than some other types. I'd rather pay up for a company with pricing power, for example, or a company providing a critical good or service. But I can see why these super investors are buying these commodity companies. I'd love to hear your thoughts. If you disagree or you have a different insight, love to hear it. Thanks so much for tuning in to Unrivaled Investing.